Deepak Shenoy is with us on the show. And Deepak, why don't we get in your take first up as to how you've looked at the earnings within the heavyweight banking names, Kotak Bank as well as an HDFC Bank, and do you believe that there is still more consolidation in store?
To be fair, I think the results have been not so great, and we invested in some of these banks. But I was, I think we expected what would come with HDFC Bank. It's only a 6% profit growth, and bunch of one-timers, right? Provision write backs, tax increases. Net of it, still, I don't feel there is a significant double-digit profit growth really. So I think they will take another quarter or a couple of quarters for this to consolidate. Plus, they have the specter, both Kotak and HDFC Bank have the specter of this new draft circular from the RBI, which says that their sub entities, which are NBFCs, which are lending in the same space, they should find a way to consolidate or perhaps lend through one entity. If the rules eventually become a reality, that will be some sort of a negative for the NBFC parts of those holdings, especially when at least HDB will probably be going public by next year. So I think that way there is a slight set of headwinds. But I feel, given the criteria that RBI seems to be talking about from MFIs and from NBFCs that are lending to retail, where they're cutting down on usurious loans being made through, say, digital channels or something like that, there is a potential that the larger banks may see more credit growth and effectively deposit growth, because that is a function of credit growth really. And I think it may be interesting to still have a contra position on the banks because the NBFCs will not be in favor.
Okay, a contraposition on banks. That's the takeaway coming in from Deepak. Deepak, wanted your takeaway on the read-through from the IT big boys. Now that all of them are out with the earnings, while they are pretty hopeful that BFSI is going to be that firing engine going forward, the results have been a mixed bag.
They have been, Ash. I think the problem with results right now is that you're on going on the back of even this coming quarter is not going to be that great, because you have a US election that is extremely polarized. Most of their revenues, a lot of their revenues at least, come from that place, and therefore policies will probably change based on who becomes the US president. And therefore I think people will be loath to kind of give big contracts, especially where outsourcing contracts in a format where you might have some kind of counter duties or something like that applicable. You may have to change structures before you do a lot more contracting. So there will be that fear that who's going to come and what are they going to do. So I don't think even this coming quarter that the results are going to be meaningfully good. All of them are equally not so great, I think. BFSI will probably do well, because in a scenario where rates come down, in a scenario where their bond profits start to show on their books, they still have extremely high amount of unrealized losses on their bond portfolios. But that loss quantum may come down if rates come down further. So they will have some more room for perhaps expansion, plus even regulatory exposures. They will have to do a lot more work on with companies like Infi, TCS, and so on. We have some positions here, but I think it's too early to call a turnaround. I'll wait for US elections. I'll wait for the time when we have more clarity. I think Jan, Feb, March might be the first time we actually get some decent amount of clarity. Prices, though, have started to stabilize on some of the stocks. So I think prices may give a indication earlier than the fundamentals will.
Wanted to get in a take then from you, Deepak, as to what the long-term implications could be for something like a Manappuram Finance, with the RBI restricting the subsidiary of the company from the sanctions and the disbursements. Is this going to play long-term havoc with the stock?
Aman, I was actually surprised that the RBI came in so strongly, but then it must have been after a lot of negotiations and talks. In fact, the governor actually mentioned in the MPC speech that he was concerned that this level of usurious lending, in a way, was affecting the way credit was growing in these areas. They haven't actually specified what has happened. Navi is going to have a call today at 5:30. Hopefully, we'll get some quality, some inputs there. But the idea over here has been that RBI said, listen, you should have had a stated policy and you should have stuck to that policy. It's possible that some of the effective lending rates, because of high processing fees, say 3 to 5% on a 6-month loan, translates to 10% on an annualized basis, which adds to the interest rate you're already paying on the loan, which can be significantly high for a small borrower. So if that becomes the problem, I think the NBFCs will have to change their track, show RBI. It will take 6 to 8 months, just as GM has taken about 6 months to be able to convince RBI about their share-based lending. So I think for 6 months, there's going to be trouble in these companies. But if they get their act together and they're able to show the RBI that they have set up processes to ensure that the rates are within their own defined limits, I think that that will help. But for 6 months, expect nothing. Manappuram will probably see that income hit for the next 6 months. Starting from today, they can't lend anymore for until RBI comes back. So I believe that they've seen these kind of things in the past. They know how to handle it. The other players probably don't. So they'll have to learn it for the first time. I don't see this as a long-term problem, but in the short term, Manappuram, I think, is going to take a hit. We don't have a position here.
Okay, that's that on Manappuram.
Look, the earning season so far has attracted more downgrades, hardly any upgrade, barring one or two. And this is for the second quarter now that earning estimates have been downgraded. What does that mean for the overall market? Because markets have moved independently of what the economic reality is or the earnings picture is.
In fact, Nikund, I think markets have moved independently of everything. You have a world war also, I think they'll go up only. It seems like that almost. But to that extent, I think earnings are under a little bit of stress. Last time we saw a problem with the earnings in retail. I think we've had not enough retailers give results, but there is some stress. We've seen this in Reliance Retail, we've seen this in DMart to that extent. I think there is some kind of consumption level stress. Diwali quarter will probably determine how bad it really is, or if there was a push towards Diwali in rather than in the earlier quarters. But rural consumption should be doing well. I think there has been both an increase in prices, inflation in vegetables in the last month or last month and a half or so. There has also been a fairly good harvest. So I don't think, and plus elections. So that trickle down effect will probably come in towards the later half of this year. So I think overall, we are seeing some kind of subdued results in most of the larger corporates. We should see some of the industrials come back to life because government orders were stalled because of elections in the earlier quarter. So we should see some kind of revival now. But I don't see a huge earnings increase this time. If we were to get at a Nifty level 10 to 11% in this quarter, I think that would be fantastic. But I don't. I mean, right now the visibility is not there. The top banks are at 5 or 6% bottom line growth. Even Reliance is at par or just a little bit below last time. So I don't see this as a very big quarter for the large caps. The mid caps and small caps may surprise us. So I think that's the thing to look out for. Right now, the downgrades in earnings, I think, are coming in only because of the larger cap results. Let's see how the small and mid caps come. Some of them have actually come out quite decently.
Talk where you expect the downside should be bought into or earnings upgrade could kick in. How are you using this volatility to your advantage? Deepak?
Was that for me? Sorry, I didn't hear that. Yes. So how are we using there's not enough volatility to use to an advantage. It was down 6%. I would say at least give me 10% so that we can do something with some of the other positions we have. But I don't think we're even getting a 10% downturn from the top. We haven't had a 20% downturn in 2 years. We haven't had a 10% downturn this year. So I don't know if the worst is ahead of us, but I think we need more volatility, more than what we have. On individual stocks, you're getting some moves, but on the overall index, and basically because everything is, there isn't actually a crisis meaningfully. We're not getting anything across the board that gets me very low prices on the stocks I really want to buy. So I would say, I would hope for some kind of a sentiment volatility for us to be able to pick up more. We're in the market for the long term. So having a short-term blip affect us is actually good for long-term portfolios. But having said that, this quarter and the next, for whether it's IT because of the US elections, because India because of the uh, the downgrades and the earnings disappointments from the large caps, I think we're going to see some level of downside for the next 2 months. So it's going to be a time to pick up stocks, I think, in the next 2 months. But then I've been thinking that for the last 3 quarters, and the stock market hasn't seemed to try to come down meaningfully. So I guess waiting for that, but we're still participating. We're still about 90% plus invested, 95, 98% plus invested. So we'll change only if the market shows that volatility.
Shenoy, you track both of them, I think, very closely. Reliance for sure, I know. DMart also, I think you track it closely.
I haven't seen DMart as closely, but I think I saw it recently because of all the news about them losing out to quick commerce. I don't think that is quite the case, but of course, at some level, the quick commerce discounting mechanisms and their concentration in the urban markets where DMart is popular will, of course, hurt a DMart a little bit more than perhaps a Reliance Retail, which has more broad-based uh, presence and also a portfolio. So I would say, in general, the retail ecosystem has changed or is changing in India, and that's a good thing. You're getting price pressure, which is also a good thing, because that means that the consumers are able to get something at a cheaper price. But such things don't last too long. At some point, you're going to have issues, especially when some of these are foreign-owned companies and have quasi inventory issues because they own inventory on their books through some kind of a side deal mechanism with some other companies. And such things effectively catch an ED notice, and then there will be some kind of action that will come in on the quick commerce setup. All the quick commerce setups have something like this going on, where they're mostly owned by foreign players, but because even though they can't own inventory, they've got their own run dark stores in a way, and that isn't really going to fly well. So I would say this in the short term, you're going to have trouble in retail. Long term, not too much.
Wanted to get in your thoughts as well as to how you're looking at Zomato and this entire quick commerce space. Just today, interestingly, we have a brokerage note, and they're talking about how the quick commerce industry is going through a phase of increased competition. And that's just putting it mildly, because a lot of big players have entered this space. The next 6 to 12 months, what does that look like for quick commerce and for Zomato?
So two things here, Ravan. First, as a consumer, utilize this time to the absolute best, because I think your 10-minute discounted, crazily discounted deals are going to probably see their sunsets in the next 1 year. So as a consumer, please, go ahead and just order as much as you can, where you're getting stuff at a really big discount, because they're not going to last. And eventually, that means you're going to have to go back to the old format of the different other stores. There's everybody getting in now. There's Amazon, there's Big Basket, there's a bunch of other players, including effectively DMarts and Reliance retailers will also get in a different way. But I feel here that there are two things. What has happened at Zomato with the QIP is that they want 51% ownership from domestic sources. That means they want to own inventory officially. So that does give them a lead compared to some of the others, but because there may be enforcement action that comes in, especially because of higher competition. When you're not allowed, you may not. Some of the other players may not be allowed to effectively even run their own dark stores, and without running your own dark stores, you don't get the efficiencies anywhere close to real in this business. So I think that is one challenge. The other one is, of course, demand. At some point, this 10-minute and 15-minute demand has gets fatigued, and you're not going to be able to continue this. And I think all of us should realize this. At some point, this is going to end meaningfully, and then then what happens? So I feel here that organized retail is still going to be a very challenging space to participate in, and some of the bigger players, I think, will respond meaningfully. So the smaller quick commerce setups may actually see both challenges from a regulatory space and challenges from the larger players coming into the competition. So just my thoughts. I don't have an investment in anything in either of these. In big retail, we have some.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.